Really what we are is three things at Permal. One is a firm that seeks the world for the best possible managers, usually independent, not part of large firms. The second thing we are product engineers. How do you mix those managers to create robust returns over market cycles? And the third thing we do at Permal is we have top-down views that we express judiciously in portfolios.
It starts off with sourcing manager ideas.
We have incredibly good idea flow because of our history with Soros and Steinhardt and Robertson. Just about everyone who wants to start a hedge fund comes to Permal.
We look for a competitive advantage. What sets this manager apart from all the other managers that we see?
I'm curious to see how he protects himself in times of extreme volatility.
We do, I think, every conceivable type of mathematical due diligence, looking at the manager's record.
You absolutely have to determine where those returns are coming from, what risks were taken to make them, and does the manager actually have some skill and a repeatable process.
We like to find talented managers early on. Not only do we want to see the manager produce superb numbers, what we're looking for is actually integrity of the manager.
There's a disciplined view of looking to find new managers. You're going to go through a process of understanding the managers, looking at how they perform, trying to take out vagaries that are not related to skill. We are of a belief that it's a business of a few good people.
Our value added comes basically in two things: finding the managers to start with, and then mixing them in a way that gives an attractive risk-reward profile.
Each of them has their own particular competitive advantage, but what you need to do is to diversify over the sources of risk that remain.
The way we use a manager, which is critical ultimately to our investors' success and our success, is perhaps better than most because we understand them better and we understand their patterns better. We've got really two levels of risk management. We have it at the portfolio level, which is a function carried out by asset management, but we also have a risk oversight function carried out of our London office.
The risk department is continually developing new models in an attempt to draw new insights into the return generation process of hedge fund managers.
Risk should be independent, and people who measure the risks should not be influenced by their proximity to people who are making investment decisions. So it's a healthy separation, a healthy check and balance system.
In terms of some of the private investments that they have within the fund, how are they valuing it?
There is a continual dialogue between the investment managers who are spending all their time going through portfolios with our managers and the analysis that we produce, and it's through a synthesis of the two approaches that Permal gets its power.